Is the stock market about to drag Bitcoin down to its final bear market low? The CryptoRover channel is flagging a dangerous rounding top pattern on the S&P 500, a classic bearish signal. He believes the real bottom for Bitcoin might not form for another 50 to 100 days, potentially around June 2026. This timeline aligns perfectly with analysis from Ben Cowen, who shows Bitcoin is eerily tracking its 2014 bear market fractal. Cowen warns that we haven't seen the time-based capitulation yet, where bulls finally give up hope. DataDash brings this macro view down to the daily chart, identifying $69,000 as the critical support level. If that key level breaks, he's targeting a fast drop towards $65,000. Are all three analysts seeing the same storm clouds gathering from different angles? We'll break it all down.
In the latest video from CryptoRover channel, the discussion kicks off with a concerning pattern on the S&P 500 chart, a rounding top structure. This is typically a bearish sign, and if the index breaks down, it could pull Bitcoin down with it, especially with turmoil in the Middle East and high oil prices adding to the pressure. While a recent bounce in Bitcoin offered a quick trading opportunity, the broader outlook remains cautious. The bears still seem to be in control, and this might just be a small relief rally before another move to the downside. To figure out where the real bottom might be, the video turns to several key charts. The Gaussian channel, for instance, has a history of flipping red right around the time a market bottom forms. Another indicator, the monthly RSI, hasn't retested a critical downward trend line yet, suggesting the low isn't in. Historical data is also a major focus, with analysis of past cycles suggesting a bottom could form in the next 50 to 100 days, or more specifically, around June 2026. This timing also lines up with patterns seen around U.S. midterm election years. It's all about surviving the next few months, as better times are expected to follow. The video's technical analysis leans heavily on historical patterns and the correlation between Bitcoin and the S&P 500. The focus on the S&P 500's rounding top pattern is particularly relevant, as recent market analysis from outlets like Stock Charts has also noted the index trading below its 200-day moving average, a sign of weakening market breadth. However, the long-standing correlation between crypto and equities might be shifting. Some analysts, according to recent reports, have observed Bitcoin beginning to move independently from the S&P 500, driven more by internal market factors and institutional demand. The video's timeline for a bottom between now and June 2026 aligns with some market commentary, but others are projecting a longer period of consolidation, potentially pushing a true bottom into late 2026 or even early 2027. Geopolitical factors, which the video mentions briefly, are also a major wildcard. Ongoing global tensions can increase volatility and drive investors toward assets perceived as safe havens, a role Bitcoin has sometimes played. Ultimately, while the on-chain and historical indicators presented offer a solid framework, the current macroeconomic environment and a potentially decoupling market narrative suggest that past performance is no guarantee of future results.
In the latest video from the Ben Cowen channel, the discussion centers on Bitcoin's predictable patterns during bear markets, particularly in midterm election years. The analysis points out that Bitcoin's current year-to-date performance is closely mirroring that of 2014, which saw a low in February, a rally into March, and then another drop in April. It suggested that we might be closer to the next leg down than many people think, possibly without even reaching the 21-week EMA. The video explains that these counter-trend rallies often create a false sense of security for bulls before a sharp capitulation. The real market bottom, it's argued, isn't about hitting a specific price, but about reaching a point of time-based capitulation, where the majority of bullish investors finally give up. This hasn't happened yet, suggesting there's more downside to come before the bear market is truly over. Ben Cowen's cyclical analysis, which focuses on historical patterns in midterm years, presents a compelling case for a continued bear market. His theory that the market requires time-based capitulation rather than just price capitulation is a classic market psychology observation. However, the current market structure in March 2026 is fundamentally different from the 2014 and 2018 cycles he references. The The most significant new factor is the massive inflow from spot Bitcoin ETFs. Recent data shows these ETFs have accumulated over $90 billion in assets, with sustained daily inflows averaging over $147 million in March. This represents a steady, structural demand from institutional players like pension funds, which didn't exist in prior cycles. Furthermore, there's a growing narrative, supported by firms like Grayscale, that the traditional four-year cycle may be breaking down due to this institutional adoption smoothing out volatility. While Cowen's historical fractal analysis is sound, it might not fully account for this new class of long-horizon investors who are less susceptible to the emotional selling that defined previous bottoms. The market is also seeing a clearer regulatory path forward, with the SEC and CFTC issuing landmark interpretive guidance that reduces uncertainty for institutional players, potentially strengthening market foundations against the kind of deep capitulation seen in the past.
In the latest video from DataDash, Paul Sampson walks through Bitcoin's recent price action after it failed to break past $76,000 and slipped back under the $69,000 mark. He explains that this kind of retracement is a very normal thing to see, especially following the FOMC meeting. A key point he shared from his earlier analysis was the expectation of a move down to the weekly pivot at $70,700, which happened like clockwork on Wednesday. This target was significant because it was a level with high trading volume from the previous week. The rejection from the highs was also signaled by a swing failure pattern above the Monday high of around $75,000 on the 4-hour chart, which gave more reason to expect a decline. Right now, Bitcoin is sitting at the bottom of its current range. For any further upside, Bitcoin needs to get back above the $71,000 region. If it fails to hold the current support around $69,000, we could see it drop toward the $65,000 low. He also briefly touched on gold, which has seen a steep 16 to 17% drop and might be due for a short-term bounce. The video's technical analysis, focusing on the $69,000 to $71,000 range, is particularly timely. Current market sentiment is being heavily influenced by macroeconomic factors, including the Federal Reserve's decision to hold interest rates steady amidst geopolitical tensions. This has created a risk-off environment, putting pressure on assets like Bitcoin. The speaker's emphasis on reclaiming $71,000 aligns with the broader market's need to see sustained buying pressure. Recent data shows that while spot Bitcoin ETF inflows have been generally positive for the month, they have shown signs of slowing, with some recent days even seeing net outflows. This could indicate that the initial institutional excitement is stabilizing, and the market is now looking for its next major catalyst. The discussion on gold is also relevant, as the Bitcoin-to-gold correlation recently hit its lowest point since 2022, indicating the two assets have been moving in opposite directions. While some analysts see this as a sign of capital rotating from gold to Bitcoin, the broader market uncertainty seems to be affecting both assets.
So after analyzing these different perspectives, what's the bottom line? Across the board, there's a strong consensus for short-term caution. All analysts see the risk of another leg down, whether that's a new market low or simply retesting key support levels. The big disagreement is whether this is a classic bear market cycle driven by historical patterns or a shorter-term dip dictated by stock market correlation. The key unanswered question is whether new institutional money from ETFs can break these old patterns. The takeaway is clear. While the long-term bull case may be intact, the market's immediate strength is being tested.